Okay, we'll go through some of the pension benefit obligation type problems and the pension plan asset type problems. So really what you want to know out of that chapter is what all goes in, or how do you calculate that projected benefit obligation, what gets included in expense, and then what goes into the pension plan assets themselves, and kind of how do those relate. So this first one gives us a company that has a projected benefit obligation of 50 million to start the year. During the year, they paid pension benefits of $5 million. There was a service cost for the year. That's to increase, it's for what their employees worked, $12 million. The pension plan assets at fair value increased by $7 million as expected. And at the end of 2024, there was no other comprehensive income accounts, and their discount rate was at 10%. So we start with the beginning balance, and we always add the service cost, because again, that's going to increase our liability. It's for the work that our employees did this year. It increases their pension benefits. Then the interest, so the interest rate is at the 10%. So the 10% times the 50 million is how we calculate out that interest cost. And that interest cost is going to increase our pension benefit obligation. It would also increase our pension expense if we were doing that side of it. And then the retiree benefits are paid to our workers, so it reduces what our liability is, or it reduces our obligation. So then we would put all those in and calculate out what the ending balance would be then at the end of the year. Okay, then this one says, okay, now calculate your pension expense in 3 different scenarios. And then do the journal entries. So as we look at that first scenario, we've got interest costs of, so let me go up to the top. Here it tells us that the annual service cost is 26 million. So that is in our pension expense, that 26 million. Then these other things are also, they either increase the pension expense or they decrease it. And then they have a $46 million underfunded plan, which means the liability is more than the plan assets. So we have, again, the interest cost of $7 million. So that interest cost increases our pension expense. Then we have an expected return on assets of the 20 million. And that is going to decrease our interest expense. And then we have an amortization of that net loss. And then the amortization of that net loss would also decrease our expense, right? So then when we put it all together into our journal entry, let's leave the pension expense kind of as our plug number, or you could calculate it, I guess, out ahead of time. But our plan assets are going to increase by that return on assets. So that's money that we made in the investments. It increases our plan assets, so we debit that. The pension benefit obligation is going to be increased. So again, because it's a liability, so we credit it. And it's going to be the 26 million and then the 7 million in interest costs. So those two added together are the 33 million, or 33. And then we're amortizing that net loss, and that amortization is a credit then into our other comprehensive income. So in a sense, then you could just, when you're doing the journal entry, that pension expense could just be your plug number. But then you could have also calculated it, like as I was listing it out, what increases it and what decreases it, because it's good to know that as well. Then in the second scenario, we still have the same 26 million, and then in service costs. And then we now have interest cost of 22. So then the 26 million and the 22 are going to increase or credit our pension benefit obligation. Now, in this case, we have a gain. So the gain, we're going to debit the amortization of that net gain into other comprehensive income. The plant assets, we have the expected return on plant assets. That's going to increase those. So that is our debit. And then again, the pension expense is going to be what's left to make that entry balance. Or again, you could work it off to the side and figure out what it is based on. So I'll just verbally say it because it doesn't really ask us to do that. But the service cost increases your pension expense. The amortization gain or loss is going to, again, depends on which way it goes. It'll either decrease it or increase it. The gain would decrease it. The loss would increase it. The expected return is going to decrease it because, again, we're making money. The prior service cost, if we have one, which I think the next one does, that increases it. And then the interest increases the pension expense. So even write those down and know it in case it asks you to just calculate the pension expense by itself. Then our third one, again, we still have the $26 million in service costs. Now we have interest costs of $22. So that's still a $48 increase, or 48 million or thousands or whatever it is, increase in our pension benefit obligation. Then we've got our expected return on our plan assets, or our plan assets of 16. So that's an increase or a debit to our plan assets. We have the amortization of the net loss. So then now again, it's back to the loss. So that's going to be a credit when we're amortizing it out. And then the amortization of that prior service cost also goes to the other comprehensive income. And that would be a credit of the 7. So either map out the pension expense off to the side and then kind of build your entries, or really I feel like you can build your entries and then use the pension expense as your plug. Okay, then now this one says to determine our pension plan assets. So we've got a beginning balance. They give us expected return, actual return, contributions into the pension fund, an amortization of the net loss, the pension benefits paid, and then the pension expense. So then what goes into our pension plan assets? So we would have our beginning of the year balance, the actual return versus the expected. So the actual return is what we truly made on the investments that we had. The cash contributions are also going to be added right into those investments. So that's going to increase that value. And then when we pay our retirees, we're paying them out of the plan. So then the other things will impact that pension expense, but they don't impact the actual plan assets. So almost think of your plan assets as like your investment account. So so say you have money in a 401k or an IRA, what actually increases or decreases that? So if you make money, if you've got interest and dividends, that increases it. If you put contributions in there, that increases it. If you pull money out, that decreases it. So really our pension plan operates that same way. Okay, then here is more of the pension expense, but now in this case, they just want us to compute it. So I think they map it out down here. So I'll go ahead and go down there. But it always has our service cost included. So our service cost for the current year is $125,000. Now then we do have, in this one, we have the prior service cost adjustments of 90. So you'll see those will be added too. So those two added together, make up our service cost in total. And then our interest here is 5%. And then it is going to be on the amount by which the plan assets exceed that benefit obligation. The difference between those. Now, in this case, though, notice it's a negative. In the past one, I think we did it was a positive because there was it was the reverse. The liability, the pension benefit obligation was higher than the assets. This one, it's flip-flopped. our assets are actually higher than our projected benefit. So we've got an extra 40,000 in there. So then we're earning, or we're calculating the 5% on that 40,000. Yeah, and that gives us the 2. But then again, it's subtracted because it's not on a liability, it's on an extra asset. So it's the other direction. Okay, then we have the net loss does not factor in there. So then our last one is the other comprehensive income. We had a gain. So if we look back up here, we actually had the 10% return. And then we calculate that difference between the 5% interest and the 10% actual return on our plan assets of 700 million. And then again, because we had a gain, we made more than we were estimating, but then that goes into our other comprehensive income. And then that will reduce when we make money. So like notice again, when we make the income here, because we have more assets and liabilities, and then when we make the money here because our actual return was more than our interest rate, it reduces our pension expense. So when it's making money, it reduces it. If it were losing money, it's going to increase it. So then that is calculating out your net pension cost again by itself. Okay, so let's see. Yeah, all right. So I think that covered all of that. And then so that 178,000 is your net cost. All right. Then our last one has you build the pension spreadsheet. Now, so this already, I have it filled in. So yeah, I mean, all of these are filled in. But when you guys would see it on your homework, you're going to have partially filled in. So you'll just be filling in the blanks. So it says it's a partially filled in pension spreadsheet, and their discount rate is 5%. The pension formula was amended, which created prior service costs of 200,000. The expected rate of return was 8%, and their remaining service life is 20 of these employees is 20 years. So when we look at that first line, they have everything filled in, so that the only 2 that are not filled in have no value in them. Because it's the start of the year. So there's no cash and there's no pension expense. So then we're going to adjust it from there. So when we go to the next line, our service cost, what they give you is the 96 pension expense. So then that is that offset, that pension expense is going to go. So this would be an increase because your pension benefit obligation is your liability, your plan assets are your assets. So when that service cost is going to increase our pension benefit obligation and make it higher again, so that because it's already a credit. Then we come down to our interest cost. So our interest cost increases our pension expense and it increases our pension benefit obligation. And then it also is going to, since that is, this is the net of those. So like if you're looking, your pension benefit obligation is higher than your plan assets. So you have a net pension liability of 100,000. Then when that service cost increased it, that's also going to increase it. Do you know what I mean? Because that would go up to 696,000 compared to the 500. Which then would be 196,000. Interest cost is going to do the same thing. So it's going to increase your pension benefit obligation, which is increasing that net pension liability, and then increasing your pension expense. Your expected return on assets is going to decrease your pension expense. And it's also going to decrease your net pension liability and then increase your plan assets because it's money coming in. Then if we had a loss on those assets, it's going to decrease our plan assets. That net loss is going to go into our other comprehensive income, and that is going to also increase the liability, again, because it's a loss versus a gain. The prior service cost is the pension expense. And then in this case, though, there's a separate category for that prior service cost that goes to the other comprehensive income. Then we have our gain on our pension, our pension benefit obligation. And then we have that would also be reducing our net loss, right? So that's reducing our net loss because again, we're gaining it. Yeah, and then that because again, the pension benefit obligation should be a credit. This is reducing it. So I might have said that in reverse the first time because it's a gain. So it's a good thing. So our obligation goes down, our liability goes down, and our net loss goes down. Then we fund it, so our plan asset goes up, and then our cash goes down, and then our pension liability goes down, again, because we put money in there. And then we pay out our retirees, so the obligation goes down, and our plan assets go down. So then you'll have one similar to that in your homework again, so you'll have to just fill in the blanks and just kind of look at what they provide you, maybe pop back up to the top if you feel like it's something. You can almost really just go line by line based on what they do provide you and then figure out what that offset is. So even if you think back to like the journal entries or those kind of things, it'll help you create this spreadsheet.